We've got everyone. Ben, can you hear us?
I can. Can you hear me?
Got you loud and clear then, Ben. Well, then I think I'll kick off. Hi, everyone. Welcome to another Meet the Manager webinar hosted by AMM. My name's James Young. I'm a relationship manager here at Australian Money Market. It's my pleasure to introduce Ben Harrison, who's alongside me today. He's the CIO and portfolio manager at Altor Capital. For those of you who haven't come across Altor in the past, they're a boutique Brisbane-based alternative asset manager. They've got four main core funds. The fund that Australian Money Market currently offers is the AltFi Income Fund, available to wholesale investors, private credit fund, mainly targeting SMEs, and it pays quarterly distributions. So Ben, I'll turn it over to yourself, mate, to sort of introduce Altor, the fund, and the wider private credit market, mate. So over to you.
Perfect. Thanks, James, and thanks for having me to talk about Altor and a bit about Altor generally speaking, and then I'll spend probably a good 15 minutes running through the private credit market and specifically our AltFi Income Fund, which is our private credit fund, and then open it up for some questions after that. So just quickly about me, I've been in the markets investing and advising for about 15 years. I set up Altor Capital about 5.5 years ago. I've got some background in engineering services before I went into finance. I've obviously worked across a whole range of different industries and also on the equity and credit stack, so as well as advisory and strategy. So quite a diverse background that I've built over the last 15 years or so. So quickly just on to Altor Capital. It's a boutique alternative investment management business, and we're very much firm believers in active management. And that through that active management, that is getting actively involved in businesses, we can generate superior risk-adjusted returns through exploiting those market inefficiencies over the last 4 years. So we set the business up about 5 years ago, but in the last 4 years, we started establishing formalized funds. We did a number of SPVs in advance of that, but for example, the private credit fund we'll speak about today has got over a 4-year track record. And we've got what we call a platform approach to investing. So we don't want to just turn away a good investment idea because we can only do credit or we can only do equity. We really want to find the best ideas and the best companies, and then have an ability to invest across the capital structure, whether that being debt, hybrids, or equity. We'll talk a little bit about the different funding structures just quickly, but really just quickly about the business. I mean, we're 100% employee owned. We've got a very deep experience in the team. There's about 7 in the investment team across those funds. In terms of the products and the funds we have, we've got the income fund. We've got an alpha fund, which is a special sits microcap fund, Aussie equities. We've got our pipe fund, which is a private equity approach to public companies. And then we've got a growth equity fund as well, which is more late stage, venture cap, private equity, growth equity. Just quickly, core beliefs are protect the downside, stick to our knitting, follow the process, and invest with patient capital in strong thematics. And there's a lot of that stuff you'll see come through as we talk about the private credit fund in particular. So all the funds have those core beliefs embedded in our investment process. Just quickly talking about the macro and thematics. So we are sector agnostic, but macro driven. So we stick to sectors that are experiencing strong tailwinds. You can see some examples there in terms of technology, healthcare, defense, environment, infrastructure services, financial services. So before we do bottom-up research, we actually are filtering and screening for opportunities across those core sectors that I've got and experiencing strong macro tailwinds. So once we've identified the opportunities, we then bottom up. So we build financial models. We engage with the executive team and the board to understand the key drivers in the business and where the value creation is. So we are fundamental in our approach, and we're looking at aligning our the funds that we deploy and the type of value add we deploy to actually gain drivers, equity and credit returns. We're not interested in financial engineering or anything like that. We are a fundamental investor in the business. And then where we're adding value, we are doing that through improving business strategy, improving corporate governance. We're working with stakeholders, so we're engaging with investors and other stakeholders in the business, and that's how we're actually adding value. And that can be as much from being, a trusted advisor to all the way up to actually sitting on the boards of these companies. Just quickly on the funding structure, there's a lot to take in on this slide, so it's probably best I just be brief and you can come back and have a look at it at a later date. But what this slide is showing is, on the left-hand side, the number of features that are attributed to financing structures. So cost of capital, dilution, documentation, amount of liquidity, the return profile, the security. And then we've grouped it into those at the top, which are more the company's objectives, but at the bottom there, we've got the investors' objectives. And sometimes they're at odds with one another, so they don't always cross over. And then as you run across the page there, we've got the different ways that we invest. So there's debt, there's quasi-equity, which is hybrids, and then we've got ordinary equity. And then, so what we're trying to do is formulate a structure that assists with the company's objectives, but also with our objectives, being the investors. How do we protect the downside? How do we give ourselves, the greatest return based on the best structure? So there's a number of things that will go into those decision points, but that's a really good sort of visual explanation of the amount of things that we're trying to solve for across all those different objectives, from the company's objectives and the investors' objectives. So just quickly diving into private credit for a couple of minutes. I think, fundamentally this market is, or this opportunity as an asset class, is fairly immature in Australia. It's very advanced in places like the US. It's something that's been on investors' radars probably only in the last sort of 4 or 5 years in Australia, and certainly probably more so in the last 12 months. So what is private credit? Well, it's basically a loan or it's debt. So there's a future obligation to repay that principal, and then also there's an ongoing obligation to pay interest that's attached to those facilities. That interest can be fixed or it can be floating. It's a great way to invest and to tailor an investment structure to achieve the objectives of the company from a funding perspective. Importantly, we're ranked in the cap structure, so we rank above equity. We have priority. And then the one thing that I guess we're sort of spending time with educating investors on is, these investments are privately negotiated. So you do have the benefit of being able to negotiate terms different to what you would if you were investing in high yield bonds or investment grade bonds, which are where sort of the public markets are in credit, as opposed to the private markets where we invest. So the market opportunity. So we recognised private credit as an opportunity, 5 years ago. I think post Royal Commission and the pressure that's been on banks, there's been a large pullback from banks and traditional funders, in particular in private credit. So that market's being filled now by other, private credit funds that are coming into the market. Those private credit funds are either focused on property exposure or corporate exposure, or a combination of those. Our fund is purely focused on corporate credit. We don't do any property investing at all in our fund. We can probably I'll give you a bit more details on why in a minute, but for us, there's a massive opportunity in this space, a massive funding gap, which we think will continue. And there's a big opportunity to be a part of this space as an investor. And for that reason, we think that there's a great market opportunity. So just in terms of the risk profile, so we're the senior debt stack, so we're at the very top of that chart there on the right-hand side. So we're the highest priority. So we've got lower risk. We can design a number of return profiles based on the way we structure up our facilities. They can be income based off the interest rate, but we also look for free attaching equity instruments that allow us to generate rates of return over and above the interest income. We can benefit from the range of structural features and control features that are embedded into the loan documents. So we can put financial covenants in place. We can put event of default mechanisms in place. We can put in restrictions on the company's ability to, expend money for CapEx outside of a budget. So there's a range of different control features that we can put into these agreements, which are very valuable and really allow us to protect the downside, which is inherent in our core beliefs. So just quickly moving on to the fund itself. So again, the fund's got an over 4-year track record. We've delivered about 11.5% per annum return over that period of time. So we've had good performance. The fund's focused on active management of private credit opportunities in the SME market that's displaying an asymmetric risk return profile. We don't invest in property. One of the reasons for that is a number of our clients already have property exposure. So they're looking for something that's diversified and differentiated. And again, that concept around stick knitting, we're not property experts, so it doesn't sit within the portfolio. We're business founders and experts in backing corporates, so that's where we like to play. What we're targeting is a quarterly cash distribution of 10% per annum. With further upside through the attaching equity instruments. And I'll go into a bit more detail about how we do that and why we do that. That's really an important feature of the fund in terms of its return profile. And then obviously it doesn't provide facilities to property, which we've spoken about. Probably the key takeaway here is just in terms of two things actually. It's the research rating and also the platforms. We received approved rating from Bond Advisor last year. After developing a sort of 3-year or over 3-year track record, we went down the process of getting firstly rated, and then secondly, getting on platforms. So we're now on Netwealth, Hub24, Mason Stevens, and obviously AMM. And, there's a continual process of getting added to platforms as we go. It's an open-ended unit trust structure, open to wholesale investors, professional and sophisticated. Management fee is 1.5% with a 10% performance fee over the benchmark, which is cash rate plus 6%. There is a redemption process as well. So there's a quarterly redemption with 60 calendar days notice before the end of that period. So there's no lockups in the fund. Okay, just turning to investment process, we talk about the 5 core pillars for the credit fund. It's very much, if you think about where the differentiators are, it's pillar 1 and pillar 5. We've highlighted those in different colours. Pillars 2, 3, and 4 are fairly typical for any credit manager or fund manager. It's due diligence, structuring the transaction and making the investment. So we won't spend any time talking about those. We'll talk about how we differentiate, and that's on the bookends being 1, origination and screening, and 5 being our value add. So on the origination and screening, we talked about targeting those sectors that are macro driven. So that's really important feature that we differentiate on. But the other is the way we think about and we assess the opportunity early. We run each credit opportunity through our private equity filter. So that's before we look at serviceability and asset coverage, we really want to understand the core drivers in the business. So we're looking at the founder, the executive of the team, what's their track record with achieving exits and growth, what's the moat around the business. So there's a whole bunch of things that we're running through that purely look at what's the business return profile look like at the equity level, and what's the defensibility around the business, from its business model before we look at the serviceability and asset coverage. And we do that for 2 reasons. Firstly, it's an additional downside protection mechanism over and above the ranking security we have in the loan document. So if there is a reason why we have to own the equity, then would we be prepared to own this business? So that's a really important question we think about from a downside perspective. But also it allows us to prepare for the upside. That is, if we can fundamentally understand the value of the business and the value drivers of the business, and we can get an attaching equity instrument to the business, then we can actually use that to generate additional returns over and above the interest income. So we can do a research bottom-up approach. We can produce financial models. We can value the equity today. We can take an attaching equity instrument against the equity based on a future state in 3 or 4 or 5 years' time, depending on the loan document duration or the loan duration, and then work out what additional upside we can generate in the loans through those attaching equity instruments. So it's really important for us to understand the equity drivers and the equity value. And then going all the way to the other end in terms of the value add. So we actually want to be able to give ourselves a really good opportunity to be able to deliver on that equity value. So we understand the drivers of equity. So let's actually get involved in this business to give us a better chance of delivering on the equity value. That way we can create those additional returns above the interest income. So where we're doing that is identifying those opportunities early, those value drivers early as part of the DD process, working with the board and management team to identify those opportunities. And then once the loan is then being invested, let's actually now execute on that plan. Let's get involved. So that's one really important point. So that's the sort of preparing for the upside again. But also we want to be involved in the business because that's a downside protection concept as well. Like we want to actually, if there's any issues, we want to be well in front of those issues early. We don't want to be just a quarterly reported enterprise like a traditional bank where they just say, give us your quarterly financials for the historical 3 months. We actually want to be involved in the business so we can see what's going on and we can get in front of any potential issues that are coming down the pipeline as opposed to very backward looking. So they're the sort of the key differentiators in our credit fund. Just quickly, conscious of time, but just sort of wrapping through the last couple of slides. So from a portfolio diversification perspective, we really want to get exposure to different types of industries, different types of loans as well. So we do equipment financing, we do secured financing, we've done some R&D financing, we've done also acquisition financing as well. We helped a public company a couple of months ago fund quite a large meaningful acquisition that was supported by an equity raising. So we've got diversification across industries and also different credit instruments. So that's important from a portfolio perspective. Obviously, duration is also very important. So we want to write quality loans for 3 years or 4 years that the income's predictable for investors. But we also marry that up with shorter dated loans as well. Just quickly, this is the March quarterly review, so it's a couple of months out of date. But what we've done, or what we sort of resulted in March, is to do the WT Financial facility, which was the acquisition funding we talked about. I just talked about a moment ago. So that was, a really important facility that we deployed for that business. And, we've got a number of different opportunities that we've been working on over the last sort of 4 or 5 months from a diligence perspective. So the pipeline is strong, but a lot of focus has been going on and finishing DD on a couple of opportunities that we're working on. One is in the renewable space, which is obviously a pretty topical conversation at the moment, given electricity pricing and energy security. Just quickly, in terms of the characteristics, again, from a portfolio perspective, we've got, different credit investments. We've got duration that we look at, also sector exposure. So we want to make sure we're diversified across a broad range of different industries, which is the chart on the left. And then on the right, we've got a portfolio of majority of secured direct lends, but we've got obviously some cash, and then we've got a couple of direct lending structures around equipment financing, R&D. There's a little bit of equity that we've carried in the fund. That's not bought equity, that's free equity that we've written up in the portfolio based on a change of equity value in those businesses. And then we've done bank guarantee financing as well. So there's a diverse range of loan portfolios, mostly secured direct lends. On the characteristics of the fund itself, there's 15 facilities. The average balance is about $2 million. And then you can see there that the effective interest rates on those and average facilities are in the sort of order of 11%. And then the duration at the moment is 2.1 years. Just quickly, in terms of the performance, we talked about that 11.5% per annum since inception. You can see the graph there. The benchmark is the black line, so that's the RBA rate plus 6%. And you can see, quite a large divergence there. And that's when we were able to realise a number of attaching equity instruments. We were able to sell them and sell them for cash. So we saw an outperformance over the benchmark. And we obviously expect that to continue over time. There are embedded portfolio in the portfolio. There are embedded option interests. So we think that they'll be realised over time. Even they're detached from the loan agreement. So even if the loans are repaid, those options and warrants will remain on foot. So it always gives us that flexibility that they could realise some return in the future, despite the fact that the loan may have been refinanced early, which has happened a couple of times. I won't spend too much time on the pipeline, but it's fair to say we've got a strong pipeline. We aren't seeing any slowdown in the number of opportunities. I think obviously recently, particularly in the public markets where we do invest into public companies in credit, we're seeing a stronger pipeline of opportunities as companies are looking for financing because they don't necessarily want to raise equity at these levels. So I think and expect that the pipeline will continue to grow as corporates are looking for non-traditional financing, whether that be equity or because that equity is not available, or because it's perceived to be too dilutive, or as banks continue to pull out of the market. Just quickly, we'll touch on WT, and then in the interest of time, we might open it up for questions. But WT is an interesting case study. This is a public company that we invested in back in March. The opportunity came up in a screening process we did in the public markets. So we do run screens and filters in ASX listed companies. We are very comfortable lending to public companies as well as private companies. We approached the managing director and gave him an overview of how Altor invests, and he returned a call a couple of days later saying that he had an acquisition that he would like to make, and he wasn't prepared to fund it all through equity. It was a very EPS accretive acquisition, which he wasn't prepared to fund fully through equity. So we worked with him to develop a unique structure that was supported by a $3 million equity raising. The facilities are it's a 2-tranche facility up to 6.7. The initial tranche was 4.7, which we funded in March. It allowed them to make an acquisition of a very large financial services business called Synchron, and the deal was completed. The interest rate's 9.5%. It's got a line fee. Interestingly and importantly, all the fees that are generated, whether they're line fees, early repayment fees, are all to the benefit of the investors in the fund as well. The manager doesn't take those. So all those fees allow us to generate returns above the 9.5, which is the headline rate, but on a fully loaded basis after line fees and early repayment fees, the cash return on that structure is closer to 11%. And then we've got some attaching equity as well, which is a warrant over the ordinary shares. So that's a bit of background on WT. I'll again, in the interest of time, we'll sort of skip over the renewable energy opportunity, which we're working on, but it's really exciting topical investment opportunity that we're in the process of closing out. So that's the rest of the presentation all done. I'm happy to open it up to questions.
Yeah, really appreciate that, Ben. Super informative. So the attendees aren't aware, you can lodge your questions via Zoom. There's a little Q&A feature at the bottom. So feel free to send through to Ben any questions you'd like answered. I've got one just off the bat. I think you went in depth about your deal origination process, how it's quite macro driven, and you target sectors specifically where you see a lot of tailwinds. Is there any sectors you're looking at now and in the future that are particularly compelling? I know you mentioned the renewables specifically, but is there any other sectors that you guys have got your eyes on specifically?
Yeah, so I think, energy and energy transition and waste management are probably a couple of sectors that we're particularly interested in. We think the macro tailwinds behind those particular segments are very strong and will continue to be, and that's a drive from not only just government regulation, but also, I think, consumer choice. So I think there's a lot of things to really like about those two sectors. And we already have an investment in a waste management business within the fund. We've also got an investment in a advanced manufacturing business that's doing upscaling from waste products into more high value products. And then if we can execute on this energy systems play that we're working on at the moment, then that gives us a really good exposure to that as a sector. We still like healthcare. We haven't got any exposure to healthcare, so we're sort of actively looking for ideas in that space. So we really like healthcare. Financial services will always be a sector we like. We live and breathe in that sector. We understand the opportunity. So they're probably, 2 or 3 of, out of the sort of 5 or 6 we're chasing, they're probably the, 3 or 4 that we really like.
Perfect. Unreal.
And I think on that, why macro is important, because we understand that businesses go through, challenging periods, and sometimes, you need a bit of momentum to help you drive through those periods of time. So, we're not naive to the fact that challenges arise, and, having a strong macro tailwind, gives you that momentum through those periods of time. And we see that time and time again.
Definitely. Well, that was fantastic there, Ben. We are getting close to the cutoff of time, so we we might leave it there. A bit of housekeeping before we wrap up. For any attendees that have completed more than 80% of the session, we'll be sending out your CPD certificates shortly. We'll also make a copy of the recording available by the AMM landing pages, and then a copy of the slides can be available via request as well. So on behalf of AMM and Altor, I'd like to thank everyone for attending, and Ben specifically for giving such an informative presentation. Much appreciated, mate. Thank you for your time, and yeah, thanks for attending, everyone.
Thanks for having me.
Thanks, Ben. Over there. Thanks, guys.